Prairie Company corporate presentation. I'm Lou Bassanese, the Executive Vice President of Market Strategy. Got to go through the normal disclaimers. Going to make some forward-looking statements. Please, if you haven't already, please read our latest 10Q and 10K filings that disclose the risks and uncertainties involved there. I really want to spend just time, keep this a choose your own adventure, so we'll get to Q&A faster than me just droning on about 14 different slides that may or may not interest you. So what do we do? What's the big picture? And why is it relevant now? I wish I could tell you that we were an AI chip company because everyone loves those and it would be way easier to convince you to invest. But instead, we're on the complete opposite end of the spectrum. We're in the most hated industry in the market right now with the lowest weighting in the S&P 500. And I'm talking, of course, about energy, right? But I'm a contrarian by trade, always have been, so I love when people hate things because it means a turning point is not far off on the horizon. So Prairie was founded on that philosophy. Our two co-founders knew that eventually the pendulum would swing back away from the idea of an energy transition, away from fossil fuels to actually an energy addition. All of the above resources would need to be used, and we would come back to the idea that we need fossil fuels. Life cannot exist without it. Fortunately, the geniuses in Hollywood came out with a great series called Landman that is now demonstrating that to the general public as well, really driving home the point why fossil fuels are so important. So we set up shop outside of the Permian Basin where everyone else was. We didn't want to go where it was crowded and overpriced and went to the DJ Basin. So all of our oil fields and our assets and our locations are located in outside Denver, so northern Colorado. We're exclusively a one-basin company. We set up there and went public, uplisted on the NASDAQ in December of 2023 with a clear mandate to grow via two ways, organically through the drill bit, but then also through aggressive acquisitions. So the long story short is we've completed over 6 acquisitions in that short period of time, the most significant being in January of this year, where we announced an acquisition to acquire assets from Bayswater, a $602.5 million acquisition, pulled off by a $150 million-ish market cap company. So we literally were the minnow swallowing the whale, but it put us on the map in terms of meaningful production. So we acquired at the time of acquisition, about 24,000 barrels of oil per day of production that we added to our existing 5,000 to 7,000 barrels. We're now averaging about 24,000 barrels with a decline rate and then our own drilling. So we run a 1-rig program, drilling about 60 wells per year. This year, as you've seen, we've already drilled and completed 35 wells through the third quarter. We're operating over 400. So we are not an exploration and production company. We're an exploitation and production company. We're not doing anything on the fringe. We're drilling in well-known areas that are surrounded by the likes of Chevron and Occidental, which you can see here on this chart. If you have amazing vision, you can read, but let me point it out so you don't have to. The yellow color blocks are our acreage in the basin. The purple is Chevron, and then the beige rose type color is Occidental. So you can see that we're largely surrounded by those two majors. There's gaps that we can fill in, and this isn't an accident. During the last boom phase in this industry, Oxy and Chevron consolidated a lot of the existing assets that were here. So it's left a great gap in the market that we believe we can exploit with a roll-up strategy, an effective, cost-efficient roll-up strategy where there's a lot of privately held assets in here where we can fill in the gaps, increase production. Our target goal is to get to about 100,000 barrels of production a day. We do have pipelines secured to handle those volumes already, so we can build it and don't have to worry about can we get the oil out of the basin. I think it's worth mentioning we are largely an oil play, not natural gas. About 55% is oil, another 55 to 60%, another 10 to 15% of that is NGLs, and the rest is dry gas. In Colorado, we can't flare, so we use that dry gas on site to pump back down well to help with extraction or electricity generation and the like. So if you're looking for a pure natural gas play, which seems to be really hot because of the AI energy trade, like I told you, we are completely contrarian. We're the oil play, mostly more than natural gas. But you see here, we are located, you can't tell completely on this map, but the far northernmost region of Colorado. People often ask where the name came from and where the logo. We are not super original. We're located in Weld County where it's nothing but prairies and there's prairie dogs. It's not very suburban, it's very rural. To give you an idea in terms of the political climate, you might think Colorado might not be the best state to operate as an oil and gas company. However, Weld County tried to secede and join Wyoming. on multiple instances. So a very favorable environment. Most of our workers actually live in the area. They're very pro oil and gas, and the oil and gas industry makes up about 80 to 85% of municipal tax revenues in the area. So this is an industry that supports the local economy in a big and major way, which helps us be an efficient operator there as well. Just some of the highlights, and then we can get to a Q&A. I'll bring up my colleague Wabi Ploegsma, who's been in the industry for close to 25 years. So if there's something I can't answer, he should be able to as well. But just exiting Q3, we did pull off this large acquisition. We closed it at the end of Q1, so Q2 and Q3 are our first full quarters where we're showing consolidated results of that acquisition. We understand as a micro small cap company that execution is paramount, so we have to show quarter over quarter progress. Here you're seeing an increase in revenue and net income and our progression of our production going up steadily over this quarter. We are back-end loaded. We shared our guidance for how many wells we're going to turn into line and sales, and more of them are in the fourth quarter. So you'll see us exit the year at a much higher production rate than we did in Q1 and Q2. Had a record adjusted EBITDA. You see our daily production guidance for the year, so 24,000 to 26,000 barrels a day. For us to hit those averages for the year, as I mentioned, we have to be much higher than that on the exit rate for the end of Q4. EBITDA over 200 million here, 240 to 260 million guidance. CapEx, we are investing in a full one rig program, so drilling a well once every 4.5 to 5 days, so 60 wells a year. Next year we anticipate doing that as well. We have over 600 locations, so about 10 years worth of drilling inventory, self-funding this with internal cash flows. As we get into next year, we'll be in a situation where we can start a return of capital to shareholders. We publicly stated that we intend to be like an oil and gas company, a traditional one, as we get to that point. So right now we want to be a high growth, low cost operator and producer, and start paying out a dividend at a reasonable time when it makes sense financially in 2026. So with that being said, I'll open it up to questions and answers because I think that's usually the most helpful use of our time. Yes, sir.
How are you funding these large-scale acquisitions?
Yeah, so great question. How are we funding the acquisitions? The large ones we did, we have a $1 billion reserve-based lending facility with Citi as the lead, includes other big blue chip banks like Bank of America, MUFG. We can do up to 80% of that production value there through that. And then the last one, we did a convertible preferred. So it was a $602.5 million acquisition. We did about $350 off the RBL, $150 through a convertible preferred, and $40 million through common equity. I will note it's the obvious thing holding back our stock is this convertible preferred because it has a 1-year anniversary, a warrant grant that could lead to meaningful dilution. We've publicly stated that we have every intention of doing what we can to redeem that to prevent that from happening. So there's multiple ways that can happen without getting into the weeds or making MNPI statements. We'll just say that management is heavily incentivized to take out the convertible pref in advance because we own about 11% of the company. So we felt it was an acquisition we had to get done with whatever financing was available at that time in the market. So we did that and had confidence we could refinance that in a judicious manner before the dilution happens. Yeah. And then other acquisitions we've done, just bolt-ons that are a couple $1 million with existing cash. As our production goes up as well, it frees up more capacity under that RBL. Right now, the last determination, we have $475 million of availability, which we've used about $400 million.
So can you just talk through the team that you've got? What sort of experience and background?
In terms of, the
executive team.
Yeah, the executive team. So I am the greenest of green. I said I watched Landman in January and joined the company. So my expertise, I've always been in the public markets, capital markets, on mostly in the investor relations, media relations side. But the executives that couldn't be here, the CEO and other co-founder, Gary Hanna. Gary has been a lifetime executive in the oil and gas industry, has done offshore, onshore, had multiple exits. Ed also worked in the oil and gas with Gary previously before. He was also on Wall Street in investment banking and did a lot of deals in the oil and gas space and then decided to flip to this side of the market. Our CFO and our chief legal officer both have done nothing but operate in the DJ Basin. And so they give us our Colorado expertise. And then our Chief Operations and Drilling Officer, Brian Freeman, used to work with Chevron, has drilled over 10,000 wells across the world. So he's one of our people that has just vast industry experience understanding the different geographies. So a good mix of mostly oil and gas lifetimers, and then a few of us with Wall Street experience. As I mentioned, Wabi, head of capital markets, he's been doing this for 25 years now. Yeah. Started on trading desks and then has been doing nothing but oil and gas.
Yeah, and sorry, when did you set up that facility with Citi? How long-
The facility with Citi was mid of,
Yeah,
you-
beginning of the year, as we were going into this acquisition of
yeah,
phase
beginning
one.
of 2025. Yeah.
If you want, you can pull up the slide with the management bios at the end. You can see they're
Yeah.
all seasoned oil and gas professionals. The last company that Gary had, he sold for $1.2 billion. I think his investors had a 10x return on them. So
Yeah, so we're adamant about being a one basin company. We feel like we can leverage the operational efficiencies there. I mentioned earlier we want to be low cost. We do that in a lot of ways of just being smart allocators of capital, but more importantly, unbundling the drilling and completion. So two majors really bundle everything here: Liberty and Halliburton. Average drilling and completion costs are about $7.5 million in the basin. We're down at $5.5 million because we've unbundled all those services and handled the sourcing on our own. We feel like we can drive that drilling and completion cost on a average 2-mile lateral down to below $5 million. So we're working systematically to do that. Obviously, there was low-hanging fruit in the early days that we could unbundle and have meaningful savings. Now we're looking at individual line items that are $10,000 here, $30,000 there, $40,000 there. So it is our goal to continue to grow to get to about 100,000 barrels of capacity a day without having to add much more headcount from here.
What's your average daily flow on those new wells, those $5 million wells?
on
Yeah.
a per well basis or
Yeah.
as the company?
No, is it as a well?
The last pad, they were averaging on an IP30 about 525.
So that's pretty strong.
Yeah,
It's
it's strong. It's not as prolific as Permian, but because the costs are significantly lower, our half-cycle returns resemble more of the full-cycle returns in the
What's your
Permian.
payback on it?
It's under a year on most of the wells.
The IRR assumes over 100,
Yes.
Yes,
or give or take?
give or take. Yeah, you could back into it. I don't know that we publicly disclosed all the IRRs, but yeah.
Well, I mean, when.
I would say if you, on average, between all of the properties, you're anywhere from, call it 55% IRRs up to 100 plus. On a blended basis, you're probably over 75, 80%.
I don't see your market cap.
Market cap's about 100 million right now.
Right, so you're trading at 50,000 flow per barrel. With 20, almost 40.
You're doing about 27,000 a day
Yes, you're
right
40.
now.
Right.
I mean, if you look at it on a market cap basis, you'll do over 200 million in EBITDA this year. Your market cap's 100. If you look at it on a flowing or on a, kind
I
of
just
your-
use that as a generalizing benchmark.
Yeah.
That's why I ask it that way, very obviously. Just to
Yeah,
give you a round number to start with.
Again, I mentioned the overhang obviously is the fear of dilution. Even if we assumed worst case scenario, full dilution, we'd be, 1 times production, we trade at $2.30 a share. So we can look at it any way, and it's undervalued if we're successful in executing and getting rid of some of that dilution overhang. So
What's your share price?
we're about right around 170. Yeah.
And what's your free cash flow per share?
well, we're not free cash flow
Yeah.
positive right now.
Well,
So
I saw you had a little bit, that's why I asked.
yeah, it was last quarter.
It's low.
Yeah, it's low.
Where do you think you will be on a pro forma?
Well, we haven't given any of that. I'll just tell you that
Well,
we
what
look
you
to be
can disclose.
cash flow positive sometime next year. That will then flip to where your maintenance capital and your growth, the cash coming in will exceed that.
Right.
So you will have cash then to potentially distribute to investors. And that's our obvious end goal, is to be distributing cash to
When
investors
you
in the
say
form
one
of a
to
dividend.
dividend distribution.
Yeah.
Yes.
Yeah.
And what about your capital outlay going forward over the next 3-5 years? And
Well,
average annual.
we haven't given 2026 guidance yet, but if you were just to kind of back into it, as Lou was saying, a 1-rig program is
You're
about
gonna be low
60
end.
wells a year.
Yeah.
But what we would not be looking to add a second rig unless you're having extremely favorable commodity prices and you're in a different stage of the company if you've already gone to that cash flow positive position.
Yeah.
So you have Chevron and Oxy. right there.
You have Chevron
We
to the west. You have, I'm sorry, Chevron to the east, Occidental to the west, and Civitas to the north. Down to the south, you have a few large private equity backed companies. Civitas, as you know, was just acquired by
Right.
SM.
Yes.
So they've mentioned that they plan to do about $1 billion in divestitures. My guess, and this is just my opinion, is that they will focus on divesting part of their DJ position.
Yeah. Our CEO has publicly said, we have a robust pipeline of acquisitions. It's just the right fit, the right economics, and financing it in the right way that's shareholder
Would
friendly.
either Chevron or Oxy be competitors to pick up those properties?
I don't think so. I think they have enough on their plate.
They
that
got
they're
high
doing.
density, that's why I was
They
wondering.
have high density, but I don't know that anyone's big enough, really, at that point. Again, I think, our long-term goal here is either we get to a very large, meaningful size where we're meaningful to a Chevron or Oxy, or we get to a large, meaningful size where we're returning a lot of cash to
Yeah,
shareholders.
that takes a bigger nut. But for you to pick up Civitas would be.
I don't think that they've tried for the past couple of years to sell the entire piece unsuccessfully. So I think that SM will break it apart and sell it as smaller packages.
Right.
And that will be available for
Probably
us.
half the price of what you're flowing out. So it would be accretive on an acquisition basis.
That's all we look at.
Yeah.
Yeah. Yes, sir.
I know you're well hedged, but what's your break-even oil price?
Yeah, we don't have it in this presentation, but it's right around $43 to $44 a barrel. You did bring up the hedging. As part of the RBL, we have to hedge out 80% of the production. We hedged out about 85% for this year at $68 a barrel. And then for 26, 27, and 28, we're hedged out around $64 a barrel. So as we bring new production online, we get pops above $60 a barrel. Obviously, we'll be opportunistic to hedge additional production. So we're not trying to be speculators, we're trying to be efficient operators. Yes, sir.
So what is your convertible preferred strike price, or how is it structured?
I could probably take 30 minutes to go through that as well. We should do separate. There's a lot of just provisions in it, but the original price, we did the offering at $450. I think the original conversion was above $495. There's a floor at $115. They have an ability to convert out, periodically. The terms of it, we're supposed to redeem in whole. Obviously, there's multiple scenarios where we could figure out ways to redeem that preferred. So, yeah, it's not even the elephant in the room that no one acknowledges. We all know it. So we, as we share with investors, you just have to watch us execute and operate, and we're highly incentivized to make sure that that additional dilution doesn't happen. I think I saw a hand back here, but.
So where, you said it was, it's Prairie, obviously it's east of the Rockies, but how far north of Denver is it?
Couple hours.
Yeah, about an hour and a half to the fields. I don't know, we have the map in this one here. If you look on a map, just Weld County, Colorado, you'll see it's right on the border with Wyoming.
It's a couple hours out. It really is just
There's
prairie
nothing out
land.
there.
It's prairie land, prairie dogs, and rattlesnakes.
It's the
Yes.
tornadoes.
Yes.
We did an analyst day, and the day before we brought them all out there, we had killed about 12 rattlesnakes.
Yeah.
They were asking why there's a whole bunch of shovels around the well site.
The other thing I think is important, to mention as we kind of get into a little more details is the regulatory environment in Colorado was a little bit volatile, to say the least. It was up and down. There's a moratorium on any new regulations, which has created a much clearer path to permitting. Here, worst case scenarios, permitting is maybe 180 days, whereas in the Permian, you can see, less than a week in certain scenarios. So now it's a well-defined process. We have a team that is working through that to make sure that we have about 2.5 to 3 years of permitted locations ready to drill, so that we always have readily available inventory to go through it.
Did your analysts welcome you with a nice target price?
We have 5 analysts covering us right now. I don't know what the blended target price is. The high point is,
I think it's about 4. The highest we have is 7. Lowest is right around 2. The lowest one with Piper is just because they run their calculation based on a fully diluted. If the preferred was fully converted, the warrants fully executed, and that's how he gets to a $2 target. But Clear Street is at
But they
7.
factored in the acquisition?
Yes,
Yes.
yeah, yeah. And they've done recent updates too, based on the latest Q3 results, so.
Clear Street is the highest with 7, and I believe Roth comes in after that at 5.
Is that data available for us investors to see?
If you give me your email, I can send it to you.
Great.
Yes.
So aside from the, obvious increase in production, are the wells, the acquired wells, are they performing, over the type curve expectations, or how are they?
Yeah, I'd encourage you to go back to the Q3 call that we did and listen to the transcript. We're actually doing some workovers there on the existing wells that we acquired to increase the production from that. We see that as another opportunity as well, no pun intended, that we can acquire assets that weren't run as efficiently or optimized as efficiently and increase production from that as well. I think we've talked through about 30 to 40 workovers that we've done already, and we're continuing to work through that as we move forward. So that acquisition had over 300 locations.
Yeah, it's kind of like low-hanging fruit there. You can go in and do relatively cheap workover to them, and I think on average we've been increasing production there by about 12.5% per well.
Who's your pipeline collector?
4
Excuse
minutes
me?
remaining?
Who's running the pipeline?
Like the takeaway?
Yeah.
So that's between Taproot, NGL, Summit, Williams.
Oh, so you got a lot of.
We have plenty of takeaway. Before we did the Bayswater acquisition, we put takeaway contracts in place ahead of it. It kind of scales up, and as you hit a production milestone, you unlock additional capacity. With the acquisition, we basically unlocked almost all of the capacity on that.
Without any minimum volume requirements, commitments. So we put ourselves in a position now where we're the buyer of choice because we have the takeaway for a lot of people.
We have the ability to kick someone offline
Right.
when we come on. So that puts us in a better position as an acquirer for any small producers around, because we can kick them off. They then, if they wanted to sell, if they were going to go to XYZ, we can still do that to them. So we're the natural buyer of
Well,
choice.
you have 550 barrels a day versus any small wells out there, doing like the hundreds, low hundreds that go in.
I mean, I'm sure, yeah, there are probably some that are on that because they're on their full decline.
Yeah.
And they're out, yeah.
Because they can collect that with trucks and stuff.
No, you cannot.
Can't in Colorado. Very,
You can-
very limited in any of those
Yeah,
provisions.
you have certain trucking provisions as the well has come online, but you cannot truck like you would in the Permian.
Right.
Just like you can't flare, it has to go onto pipe within a certain time period.
All right, well, listen, we thank you for your time and your questions. If you have any further questions, we're around and we're happy to connect you with CEO and CFO too, if it makes sense. Thank you.
With more than 6,000 small and micro cap companies listed, if you're looking for the next Apple, then Channel Check truly is your trade. It's an investor community where you can access independent Wall Street research, advanced market data, balanced news, corporate videos, and podcasts. You can even register to attend in-person Meet the Management Series luncheons, and to be part of the preeminent annual Small and Micro Cap Investor Conference, NobleCon. And here's the best news. Since Channel Check is sponsored by the featured companies, premium membership requires no investment. It's absolutely free. So check it out. Log in today. Find out why Channel Check is North America's leading source of research on the companies that just may change the world.